hello traders, and again volatility very much at the epicenter of what we're seeing there. You're seeing implied volatility in the S&P or the VIX index trading above 25% for the first time in some months, and of course in that environment you're going to be seeing risk aversion coming through in markets. A 25% vol is certainly very much thematic of further appreciation in the yen, lesser so the Swiss franc these days, but certainly the Japanese yen is the currency du jour. We've certainly seen some gains in the Canadian dollar, but that's more to do with the hawkish Canadian central bank. But you know, how do we play the yen? Well, certainly we like that against the euro on rallies. If we get euro yen a bit higher, then certainly after the ECB we'll be looking to sell into that. Also the Swedish krona, the Swedish economy very leveraged to what's happening in Europe. It's a very open economy, so therefore a lot of those thematics will hit Sweden very hard very early. And I think, you know, the Swedish krona is a really interesting way of playing a deteriorating picture coming through in Europe. We want to have a look last night, not just at the PMIs in Europe, but also the level of demand for reserves from the ECB through their MRO operation, which I think comes out every week, and it's something that we look at very closely just to see how, not just how much reserves are taken from the ECB to address their balance sheet and their liquidity issues, but also the number of banks, and that's pushed up well above 40 banks. Yeah, that's a significant high from where we were back in August, where we saw just above 20 banks coming there. So yeah, there is a situation that's unfolding in the European banking space that really does need to be focused on. If you have a look at the Stocks 50 banking space, it's in an absolute free fall at the moment, and it's very hard to trade that in any other capacity than being short, and certainly that's playing through in a lot of these European equity markets, which look really weak at the moment. I'll be continuing to trade these from the short side, selling any kind of rallies here. And in fact, euro as a currency, I think looks quite weak at the moment against the dollar. You know, you're seeing that eyeing the 113 lows that we got back in August. Again, you know, any kind of strength that we see there from the ECB tonight, if they give a somewhat more hawkish assessment than what the market's been looking for, then of course I'd be looking to sell into that, and specifically against the yen, where the yen, as I say, looks quite strong in this environment. Yeah, if you have a look at the S&P, have a look at the Nasdaq. The S&P had a 3.5 Z-score move last night. Again, you know, relative to the 90-day mean, that's a huge statistical anomaly, and very rare in terms of those occurrences. You know, most stocks were down, but we did see some buying coming through in the staples and utilities. So a very defensive position market, which you'd expect when you see a sort of 3.5 Z-score move to the downside. The Nasdaq, if you have a look at that on the monthly chart, big bearish outside month reversal. So price has opened above the previous month's close, traded above the high, and it looks like it's going to close firmly below the low. Very rarely do we see that. We certainly very rarely see that at all-time highs. And when you do, when you get the confirmation in the next month that we see a lower low, you know, it's pretty clear that we've probably seen a high in these markets. The S&P continues to find no love in this market. We're looking at all these different support levels. It traded through the recent low. It's traded now through the 200-day moving average. It's broken its primary uptrend from 2016. A lot of people have been focused on the 55-week moving average, which has defined the trend for 2.5 years or so. And that's been broken to the downside there. Whether it can close there is another thing. But, you know, in this environment with the VIX is at 25%, there's no buyers in this market. Short sellers are absolutely going to town at the moment in some of these high growth stocks. AMD is getting demolished. You look at Nvidia, which was obviously the poster child of all things momentum over the last few years. It's been getting absolutely decimated. Okay, Tesla's been doing pretty well because it's come out with some good earnings. But a lot of these names are getting badly beaten up at the moment. The Nasdaq looks really, really poor. If you want to trade a short index, that's probably been the one, along with some of these European markets. And also we're looking at peak earnings growth. That's been the buzzword on the street at the moment, is have we seen peak earnings growth? The likes of Caterpillar coming out with some poor outlook. AMD coming out of a poor outlook around China as well. So certainly we are focused on that. The level of beats versus misses has been quite impressive in a positive fashion, but it's the outlooks that people are looking at quite poorly. Plus the deterioration that we're seeing in some of the data points are suggesting that perhaps, you know, we're looking at a desynchronization of global growth, whereas the synchronization story was which propelled markets. And then of course you can mix in these liquidity measures that I've been talking about. There's less liquidity in markets, balance sheet reduction, quantitative tightening, funding costs going up as well. And again, all of these things mix into a situation which can have big moves. When the VIX is at 25%, you can see very big moves very quickly and very sharply. And of course, that needs to be monitored very assessingly. And plus, we've got the US dollar higher here. We've got the dollar index breaking out as well. That's something we looked at very closely. You look at credit spreads. If you look at high yield credit spreads relative to US Treasuries or the risk-free rate, they're pushing and widening, as you'd expect to see in this risk-off environment. But we are getting to levels where we're starting to see a breakout materializing in this. And if they continue to go higher, then you are going to see continued risk aversion. And it leads me to the number one question that we've got on the desk at the moment. What is the circuit breaker? The circuit breaker has to come from a central bank, one suspects, and everyone's asking, where is the Fed put? Go back to September 2015 when we saw the devaluation of the renminbi, a 4.5% devaluation. Of course, equity markets came under a bit of pressure then, and of course, the Federal Reserve decided not to raise rates when the market was thoroughly expecting to see that. You go back to when oil prices dropped about 50% into 2016, and break-evens, inflation expectations dropped out of bed, and of course, then the Fed decided not to raise rates around that time as well. And certainly that's where we are at the moment. Where is the circuit breaker? If you have a look at the Bank of America Merrill Lynch survey, about $600 billion worth of money which has been managed. The consensus view there is we're probably likely to see this down towards 2,390, which is about 18.5% drawdown in the market from the September high. So we're obviously still well away from where the Fed or the consensus believes the Fed are going to actually turn much more bearish. But because of the tightening of financial conditions that we're seeing, with LIBOR rates moving higher, funding costs going up, volatility measures going up, equity markets coming down, real yields being quite high, there is really no lesser need for the Fed to raise rates, because we are seeing a tightening of economic conditions. We're seeing a lot of these housing metrics in the US under pressure at the moment, and that's doing a lot of the heavy work for the Federal Reserve. And we are seeing that now in the interest rate markets. If you look at what's priced into the euro-dollar future curve between December 2018 and December 2020, we've already seen a full one rate hike being priced out over the last couple of weeks. And that's something that we will be monitoring there. The dollar's rallying, but it's rallying against select currencies such as the pound and against the euro and the Swedish krona. But certainly I think this is definitely the question on the street. Where is that circuit breaker? Where is the Fed put? At what levels in these equity markets do we see a situation where the Fed turn much more bearish or dovish at the margin here?